Good day, ladies and gentlemen. My name is Charles Sells, and welcome to the basics of investing in tax liens and why we love Illinois. Illinois is a pretty easy state to fall in love with when it comes to tax liens. And that's because of their compounding rates and their high penalty of redemption should you buy a tax lien and it be redeemed in the state of Illinois. This slide here, we'll get into a little more detail as we go through, but this slide here is just a quick example, a quick snapshot of what we're going to discuss here in a minute. As you can see up here at the top, we have an investment amount of $2,264.59. The interest on that was $407.63. If you look at the dates, however, this lien was purchased in February of 2016, so February 22nd. It was redeemed in March 8th. So this was actually about 3 weeks that this investment was done. And as you can see, it's a penalty, so it paid 18% within 3 weeks. That's what investors love about Illinois, is the fact that these penalties can accrue so quickly and that it's actually paid on the day of the redemption rather than prorated throughout the year. What else they like is the compounding effect. If you come down here and you look at the bottom, in the state of Illinois, every 6 months, whatever your bid rate is, it's going to multiply itself every 6 months and a day. So if you bought it at 18%, that becomes 36%. After a year and a day, that becomes 54%. And so on. So it can actually get up to as high as 108% on the redemption total. So you can see this one at the bottom here was bought in February of 2013, and it was redeemed in January of 2016. You can see the interest there actually exceeds the original principal amount, or 108% return on the redeemed certificate. All right, so before we go too deep into this, first let me say, don't believe the hype. Obviously, with tax lien investments, you've done a lot of research. You've found a lot of pie-in-the-sky claims about this business and how you can reap the rewards and get rich in a year. That's not going to be the case. We're going to show you some reality, but you can make substantial profits in this investment vehicle. What I've got on this slide here is just real quick. These are actual statements and actual claims of other coaching programs, other servicing agents that are out there, our competition, if you will, of what they state. Earned 8 to 25% government guaranteed. That's a misleading statement. Yes, the states regulate the legislation that conducts the tax sale and the terms of the sale, but nothing is guaranteed. Receive a free and clear tax deed. That statement alone, a tax deed is not free and it's not clear. There could be other red tape that has to be taken care of in order to clear that deed. Yes, you get a deed to the property, but it may have a lot of things that you need to do with it before it's actually a marketable deed to the property. Sounds too good to be true, but it's the law. Yes, it is the law. However, there's a lot that goes behind it. And again, you have to do your due diligence. You have to know those laws, and you have to conduct yourselves by those laws. So it's not just go do it, and the government's going to guarantee and pay you back, to a month, 2 months, 3 years down the road. Turning $20,000 into $20 million in 1 year. Yes, folks, this is actually on somebody's homepage, their website. This is never, ever, ever going to happen. So we will look at what realistically can happen, but that is just not the case. And finally, we bought this property at a Florida tax sale for just $500. It was so easy. We're not going to discuss Florida. We're talking about Illinois right now. But I will say that there's no possible way that property was bought for $500. There wouldn't even have been a lien sold on that property for $500. In the state of Florida, they actually conduct 2 tax sales, a tax lien sale and then a secondary tax deed sale. So let's keep going and get right into this. So I have inside the mind of a tax buyer coaching program. Again, when you go onto these infomercials or you find something online, they make it seem so simple and so sweet and so easy. You just buy a tax lien, you process redemptions, and you pay sub taxes as you hold on to those investments, and those investments redeem. You consider secondary markets where you could pick up what they call over-the-counter liens. We have a different type of secondary market, which again is in another online tutorial, but that is another way that these coaching programs try to convince you to buy is over-the-counter liens. And let me tell you, if it didn't sell in a tax sale, which are very competitive, then you don't want it. You don't want to buy an over-counter lien. If nobody that in that room did all their due diligence and nobody wanted to touch that lien, and it's still available to buy after the sale, there's a reason it's still available. So then you have pre-foreclosure, you've got REO, you got quiet title action, list it with an agent, and eventually sell the property. Okay, so that's how these coaches want you to believe this process works, and it's just not the case. This is actually what a real tax sale buyer looks like. It's a very convoluted process. It's a great investment model. It's a great investment vehicle, but there's a lot to it. You buy a tax lien, maybe I should sell the lien. How can I expedite the redemption? You process those redemptions. Do you pay the subs or do you not pay the subs? There's legal docs that you have to file on time. There's a lot that just goes into this. So I absolutely 100% believe you cannot teach or you cannot provide a coaching program to give you all that inside knowledge. It really has to be done through experience. And although I will say that there are one or two coaching programs that are very, very thorough, it's still very difficult for the individual out there to go out there and try and compete with the seasoned guys that have been doing this for 10, 15, 20 years like we have. So what is a tax lien? Very simply put, it's a reliable and predictable source of revenue for local government. So that's going to be on the county level of government. Essentially what happens, your property taxes, if you own your property outright, or even if your taxes are escrowed through your mortgage company, sometimes they slip through the cracks. They don't get paid, and therefore the county government doesn't have the revenues to support their budget. And that budget covers things like hospitals and roads and schools and teachers. So what they have to do is they have to sell those taxes to an investor like you or I. And as an incentive, they usually charge a pretty high premium on what you will be paid back when those taxes are paid off by the homeowner or the mortgage company. In every state, whether it's a tax deed or a tax lien state or a hybrid state, there's a set timeline that you can redeem the taxes, and it's going to vary by state, but there's a set period of redemption to pay the taxes, and once that period is passed, we call it maturing. The lien is matured, you're allowed to foreclose on that particular property. Process is pretty darn simple. Taxes become delinquent. They are advertised for sale, usually in the local paper for a period of time. And then they go to auction. We bid on them at the auction. If we win, we come back with tax lien certificates. You've got that period of redemption and maturation I just spoke about. That could be, again, it could be as little as 6 months. It could be a year. It could be like Illinois, which is 2.5 to 3 years, because there is a law that allows us to extend that right to 3 years, and we automatically do that. And then there's foreclosure and quiet title action. So that's the basic core of the process. Obviously, there's a lot of behind-the-scenes things that go on as well throughout each of these stages, but that's the core of what's going to happen. About 10 years ago, the PIP group started defining tax lien investors into two very specific categories: redemption investors and property investors. The infomercials you see on TV and a lot of what you find online, they really push heavy on buying tax liens to acquire properties for pennies on the dollar. And if you've ever met me in person, I hate the term pennies on the dollar. Can you acquire the property? Yes, but it's not going to be for pennies on the dollar. It's probably going to be like $half on the dollar. Still great opportunities. However, we did notice that there's a lot of passive investors out there that they don't care about the property. They just want that high interest rate. So when you approach PIP to invest, we're going to categorize you as either being a property investor or a redemption investor. If you're a redemption investor and you just want to invest in tax liens, you want to get the most out of those tax liens and let them redeem over and over and over again and keep doing it, we're going to recommend states like Illinois. Illinois is by far one of the highest, one of the fastest redeeming. It can drag out a little while because it is a 3-year right of redemption, but it pays the highest penalties that are out there. Property investors, we're going to suggest states like Georgia, Texas, South Carolina, because the way the laws are set up, the odds of you foreclosing on those properties is high, and the redemption or the maturation period is short. So when you talk to us, we're going to determine what type of investor you are, what type of exit strategies are you looking for, and then we're going to gear your investments in that direction. And again, we're going to work with you one-on-one, and we're going to make sure that your investments are up to your expectations and that you're not investing as a property investor when you truly wanted to be a redemption investor. All right, so let's jump right into Illinois. As I said, the maximum bid rates are 18% penalty on the tax lien amount for each 6 months, which is a 36% annualized max. So what happens if we go to the auction and we buy it at the highest bid rate, which would be 18%? The way it happens is you start at 18. It's not like those car auctions you see where it goes 18, 17, 16 and a half. It goes 18, 3, 2, 1, 0. And it's literally that fast. So if we buy it at 18%, that means that if we buy a tax lien for $1,000 on a Tuesday and the following Wednesday it's redeemed and we bought it for 18%, that means they owe you $1,180. Penalty means you receive the full rate. If it's redeemed, that means you're going to get all 18% on that redemption. So if it's 18% and it's 6 months, you're going to get 18% throughout that entire 6 months. If it's 6 months in a day, it's going to be 36. If it's 12 months in a day, it's going to be 54, and so on and so on. So you can see all of this here. And what I like to do is, in everything we do, we like to document and let you go do your own research. So when you have a moment, take this Illinois tax code down, put it into Google, and it'll punch all of this out for you. Obviously, it's a lot of other information, but you'll see all of this in the Illinois state legislation. Okay, so this is just a tax lien certificate. This is what you get after the sale. It looks a lot like a bond. It acts a lot like a bond. This is, you need this. This goes into our offices. They go into a fire safe and they are treated like cash. In order to foreclose, you're going to need this. In order to get that redemption, you're going to need this. So what this certificate shows is the date of the sale, the parcel number of the property class code. I can look at this and see that it is improved single-family residential. It gives the assessed to and their mailing address. That may not necessarily be the property address, but that's where the bills go. It's going to give you the penalty rate that you bought it at the auction, and it's also going to give you the amount you paid for it at the auction. So again, this certificate is your bar of gold, if you will, for getting paid in the redemption or initiating foreclosure when that time comes. Okay, so as we've already discussed, state legislation regulates the amount of time a taxpayer has to redeem. And in Illinois, that is 2 to 2.5 years, depending on the classification of property, i.e. is it single-family residential, is it a vacant lot, is it improved, that sort of thing. We extend everything to the 3 years. You can extend it by 6 months. The reason being, again, is because we classify most investors in Illinois as redemption investors. They just want that high penalty, they want it to redeem, they want to do it again. So we want to extend get that compounding interest and give them enough time to pay, give them as long as possible to pay, so we can do it again. In Illinois, we must petition for deed prior to the expiration of the right of redemption. As a comparison, if we bought a hybrid lien in Georgia and we bought it on January 1st, on January 1st of the following year, we initiate foreclosure because it's gone 12 months exactly, and it's a 1-year redemption period. In Illinois, even if we've extended it to 3 years, we have to start filing the foreclosure processes at about 2.5, a little less than 2.5 year mark. So Illinois can be a little tricky with some of the way that their laws are structured. But again, it goes back to understanding what you're investing into and understanding the laws that support the investment. All right, so this slide here is just, it's a little fuzzy, but it just gives you an example of how that compounding effect works and how the process goes. If you go to one of our other broadcasts, which is redemptions, I believe it's redemptions and how the process works, you'll get a little more detail on how, step by step, how that process works. But essentially what we do is a homeowner goes in and they pay their taxes to the county. The county then sends us this report and says, hey, these taxes have been paid, send us your certificates. We go into our file cabinets, we pull out your certificates, we send them in, and then they send us a check. The check comes made payable to you because these investments are yours. They are always placed in your name. So they send us the check, we compare it to the redemption report, make sure everything adds up and matches up, and then we send you the funds and record everything into our databases, which you can have access to on a daily basis. You'll get a login and you can see what's going on with the activities of your account daily whenever you want to. So this is just an example of how that whole process works. Okay, and one more time just for you to do the math yourselves and see how the compounding works and understand what we would have bought it for versus what it redeemed for. This is just another example of a redemption report, different county, and the check that was sent to us. Now, Illinois, obviously, in order to achieve the kind of rates we achieve, we have to cover a lot of territory in a very short period of time. In the state of Illinois, we call it investor season. That's because the auctions start around mid-October, and although they do go all the way to March, the bulk of them, the lion's share of them, happens between mid-October and the end of the year, so before Christmas. Out of 107 counties in Illinois, the PIBP group invests in 97. So clearly at that time of the year, we are extremely busy. But that's also how we achieve such high rates, is because you have hedge funds and large buyers that don't have the time, the energy, or the resources to go hit all the little sales to add up those great returns, those great penalties. So they focus on the big sales, and their margins are very thin. If we go to a sale, let's say in McLean County, Illinois, which is Bloomington, Illinois, the average purchase rate in that auction is going to be a penalty of about 3%. Sometimes it goes even lower. Last few years we've seen these big sales go at 0%. I don't know what the logic is in that, but some of them do. We tend to spread out all over the state and hit all the sales and be able to get that good return. Even if we end up foreclosing on the properties, somebody's going to buy it, somebody's going to want it. So when you say, oh, no, well, you're only buying in rural areas, that's not true. We're not only buying in rural areas, but we're also buying good properties in rural areas. So farmland, farm properties, some good stuff that's out there. Okay, now we're actually going through the statutory requirements that more or less conduct the sale, and I've actually taken this straight off the state's legislative pages, so you can go read all of this for yourself as well. There's usually a required minimum of $250 to $500 registration fee. They do apply that fee to the purchase. However, if you're an individual tax buyer, you may go to 10 sales and wind up being bust, not placing any money before you actually have a successful one. So that can get really costly for an individual investor trying to break into the state of Illinois. For PIP clients, that cost is our burden. So we may go to 10 sales and not place anything, but we're that's part of our administrative cost to go to all these sales on your behalf. Another oddity is that you have to register in writing 10 business days before the sale. And yes, they will consider holidays a weekend. They will not allow you to register if you're on day 9 because Monday happened to be Labor Day or something to that extent, a postal holiday, whatever. And as I mentioned, 2 to 3 year redemption period. There are legal requirements throughout the life of the lien that have to be followed, have to be taken care of, and have to be done. If even one step of that process is not done, you cannot foreclose on that tax lien you bought 3 years prior. So again, as I said in the very beginning, you really got to know what you're doing if you're going to jump into these states, and make sure that you follow the laws very, very specifically, which is what we do for you. Registration is very simple form, very simple process. Here you have it. As you can see, the total cost to register for this sale was $400. That's going to include the cost to register as well as the cost of their tax sale list. So we said $250 to $500. Those are pretty set fees, and then they have an additional cost for the tax sale lists. So again, if you're unsuccessful in 10 sales and now you've paid registration plus the cost of the lists, you could have yourself in a real sticky situation, in a losing situation, very quickly if you're not using a servicing agent that knows the good counties and knows where to be successful. But this is just an example of what a registration looks like. Okay, so more information stripped straight from the state legislation. I've already covered this, so I'll leave the slide up here for a couple of seconds so you guys can read through it. But again, it just goes to understanding what you're investing into and where you're investing into, and knowing that the laws are different for every single state. And then the policies within each state, within each county, are going to be different as well. Although the laws remain the same, the policies could be very different. So I'll leave this up here for just a second. Legal requirements we have to file within 3 to 5 months of the purchase of the lien. This is called a take notice. It's pretty clear. It's a pretty standard form. Certain counties require they be filed in certain ways, different ways. The formatting, all the information's the same, but the formatting may look a little different. But it looks very much like the tax sale certificate. It will contain the amount, the year of the taxes that were sold, the legal description of the property, when it was sold, how much is owed at the time this is filed. We have to file this in triplicate. We get an original copy, which acts just like the certificate. If we go to foreclose, we have to have that original. A copy is filed with the county, and then a copy is sent by certified mail to the homeowner, the mortgage company, whoever has an interest in the property. So the information is pretty simple. It shows the amount of the sale, the interest it's currently earning, which we call a penalty because it is paid the next day, the mailing fee, which we pay to the county, which part of is refundable when the lien redeems, and the clerk fee, which is not a refundable fee. So we send this out in triplicate within 3 to 5 months of the tax sales on every single lien we buy. So about 9,000 pieces of paper a year are sent to the counties, and they then process these and send them out. All right, about this point, you are starting to develop a lot of questions. So what we do here is we post a lot of frequently asked questions. We don't go through them. That way you don't have to listen to me drone on and on. But I would recommend at this point you hit the pause button on your player. Take a look at the questions and the answers. These are questions from actual clients and prospects that we use. We don't just generate these, and these are actually our answers that we provide them in emails and whatnot. There's a few pages of these, but in between some of the pages, we do have some more learning to do. So again, hit your pause button and read them on, and let's continue on. All right, so what is a tax deed? A tax deed is essentially just used to convey the title to the property after you've gone through that foreclosure process. And it varies from state to state. It can be a very complex, difficult judicial process to get the foreclosure done in a state like Illinois. I wouldn't say it's difficult. It's a lot of paperwork on us to get it done. A state like South Carolina, it is a snap. It is so easy. In Georgia, it's kind of in between. But nonetheless, a tax deed conveys your right to ownership of the property once the foreclosure right has been done or has been completed, or the right of redemption has expired and you've applied for the lien. Depending on the state, again, may require judicial or court involvement to obtain the title. Or you may obtain the title directly from the auction. Georgia is what we call a hybrid state. You get a deed to the property when you go to the sale, but it acts like a lien for the first year. You can't go and collect rent. You can't go fix the roof and cut the yard or do anything like that. The tax deed you receive is earning a 20% penalty for the first year, and then you can foreclose the rights to redeem. So tax deeds 101 is essentially what I just mentioned in the previous slide. However, to add a little more to it, in some states a tax deed could be as marketable, or i.e. insurable, you can get title insurance on it, as a standard warranty deed. A state like Kentucky, for example. We don't invest in Kentucky, but what you get from the auction is a clean, clear title to the property. In other states, since we've spoken about South Carolina, there could be some red tape involved. You still own the property, you can sell it, but to make it more marketable and be able to get insurance on it, you want to either go through a title certification process, or you want to do a quiet title action. Quiet title action is essentially a formal judicial process that clears the red tape off of the property. Oh, and one more note. In the state of Illinois, since we're talking about Illinois, the foreclosure process is so lengthy and convoluted because it is going through a quiet title action simultaneously with the foreclosure process. So the first and number one question that is always asked of a prospect that is learning about tax liens and investing in tax liens, and essentially what their collateralization is and how it's protected, is what about first mortgages or second mortgages or mechanics liens, that sort of thing. Tax liens are a super lien. What a super lien essentially means is that they are superior to any other lien on the property, to include first mortgages. The mortgage company has the right to redeem the taxes just like the homeowner has the right. And as such, they also can potentially lose the property if they don't exercise that right. Now, obviously, there are some exceptions to the rule. IRS liens have superiority over a super lien like a tax lien. Code enforcement or municipal liens. These are going to be things like, the property has been neglected because the taxes were sold at the tax sale, so the grass is overgrown, so the city goes out there and cuts it for protective measures. Those kind of things. Those liens are always usually very small, and we actually have a department that handles just lien mitigation. When we get into the foreclosure process, that's what they do, is they contact the city and essentially say, hey, we're foreclosing on the property. We didn't have a financial interest other than a tax lien before. We do now. We'd like to pay the cost to remedy this, but can you knock off some of the fines, and we'll keep up with it from here on out. So those will be part of the foreclosure process. But again, tax liens are a super lien, which means They are stronger and better than first mortgages, second mortgages, mechanics liens, that sort of thing. The only other biggie is going to be the IRS. In tens of thousands, probably hundreds of thousands of tax lien processes I've done, I have never seen the IRS go after the property itself. They're interested in the individual, and what we have to do is we have to give them a 180-day notice of our foreclosure process. At the very worst, the foreclosure processing will be slowed down, but they're not going to make a claim to the property. All right, folks, with the exception of 3 pages of frequently asked questions, this is the last slide in this presentation, or this lesson, if you will. And this essentially shows you absolutely what happened from beginning to end if the lien doesn't redeem. As you can see up top, we have a house that when we bought the lien, it looked like it was under repair. It had some openings on it, and we thought it was going to be a good lien to buy, and surely whoever was making these repairs was not going to allow this property to be foreclosed on while they were in the midst of the repairs. As you can see, they did. They finished all the repairs, and we still foreclosed on the property. And quite honestly, I'd say 30% of the business we do in foreclosures, a builder has been in there at some point trying to rehab or renovate the property, and they just defaulted on their loans. So whether it be a tax lien or a regular bank foreclosure, we see it quite a lot. Looking up here at the top, you can see this certificate was purchased at a tax sale in 2012. So we started the foreclosure process of that particular lien. The investment date was actually 12/28/2012. The market value of the property at that time was $80,773, and I can see $80,000 worth of property in there. But for sake of being very conservative, the numbers we're going to display here are going to be much smaller. The lien cost at the tax sale was $1,675.68. We purchased it at a penalty rate of 17%. So again, after 6 months and 1 day, that would have becomes 34% penalty had it been redeemed. We initiated the foreclosure process 3 years and 1 day from the date of the purchase. The foreclosure fees, this is going to be attorney's fees, this is going to be court costs, that sort of thing, were $23,24.33. We had to pay the back taxes. Now, again, this is a 3-year sale, so the taxes are going to continue to go to future sales. So that's going to be an investment once you do finalize the foreclosure process. So that's something to keep in mind when you initiate the foreclosure process, is that additional taxes will be due once we complete it and you become the new owner of the property. So the total investment was $10,033.52. Now, for hypothetical, we're assuming, at the time of this broadcast, we have not sold this property yet, but assuming we sell it for $40,386.50, that's going to be 50% of the market value of the property. So that is essentially a 300% return once we do sell it, if we sell it for 50% of what it's actually worth. We won't sell it for 50% of what it's actually worth, but we're looking to keep things conservative, keep things looking legitimate and real here. We don't want to give you the pie in the sky. This is what we're doing every day. So this is taking it through the entire process of buying the lien, sitting on the lien, going through foreclosure, going through everything. So, at the end of the day, it's a great investment. It's a great return. But as you can see from this presentation, there's a lot involved in between. So now we're going to move on to the frequently asked questions. And as I requested earlier, I will leave the slide up long enough for you guys to hit pause, read them at your leisure, and then I'll move on to the next and do the next for the next 2. I thank you for your time. I've kept this under 40 minutes, which is a new record for me. I appreciate the opportunity. I appreciate you listening to this broadcast. And if you have any questions, if you're looking for any more recent activity that we've done, if there's anything we can do, get on our website, look at some of the examples we've done, watch our free educational lessons. They're always free. We always try to provide recent realistic examples of what we're doing, so investors can see that this is what we do every day. This isn't just an idea we're trying to sell you. So again, thank you very much, and enjoy the frequently asked questions.